What's up everybody? This is just a quick video to address this bear flag that everyone is seemingly talking about. This opinion is spreading rampant over all the major analysts and everyone's basically talking about it. So let's discuss this. Is a bear flag breakdown currently what is going on for Bitcoin at the moment? And if we do draw the flagpole of the bear flag, then it will look something like this, which if we extrapolate it over to this breakdown right there, then it would bring us to, give or take, 18,800, right? Or about 19,000. So is that possibility, well, possible? I would like to preface this by saying that bear flag or not, the markets move generally on liquidity. It's not about patterns or whatever. Patterns are very useful, but at the end of the day, you should base your analysis off liquidity. And when I talk about liquidity, I'm talking about previous swing lows, right? Levels like 33,800, levels like 34,600, and levels like 29K and 28,750. So these are levels that I mentioned because they have liquidity trapped beneath the swing lows. And why is that the case? Well, you have to think of it this way. When you are a trader and you are looking into getting into a trade, most likely, if, let's say, I place a long, say here, right, at this white line here, which is quote-unquote support, let's say I place a trade there, where would I realistically put my stop loss? If I'm going to bet, it's going to be below either one of these swing lows, because as a trader, you're going to be looking at those swing lows and you're going to go like, hey, price has found quote-unquote support at these levels for multiple times. So if I just put my stop loss underneath this support, right, quote unquote support, then I'm going to be successful. And the market makers know this, right? The market makers are the ones that move the markets. They have data on where your stop loss is placed and etc. So that is what I mean by liquidity. When everyone places their stop loss at the same spot, when price hits that level, what's going to end up happening is there's going to be a lot of market sell orders that trigger. And guess who's buying when those market sell orders trigger? That's right, it's the market makers. And immediately what they're going to do is they're going to reverse the price. I don't know how many times you've seen this, but if you watch that video that I made on Bitcoin just a few days ago, when I mentioned that price was going down, and I knew exactly when price was going down. So I'm just going to discuss it shortly, but if you want to figure out the three main reasons that I knew price was going down from this exact point right here, then you're going to want to check out that video. It will allow you to consistently, on a week-by-week basis, identify if something's going to pump or if something's ready to dump. There are three factors that I use. Check out that video. But I was able, for one reason, right? I'm going to give you one reason. I was able to identify that price was going down from the fact that it has taken out this liquidity right here. And I want you to visualize it this way. If you are a, say, retail trader and you think that this could be potentially resistance, right? This line at this swing high right here could be resistant. Once price breaks above this line, as just a general retail trader, which is basically most of the market at this point, you're going to be thinking, hey, price is breaking resistance, so it's time to go long. And that is exactly what the market makers want you to do, because immediately after, what they will do is they will reverse the price. The reason why they reverse the price is because they are here to trap buyers. The people who are buying here, guess who's selling to them? That's right, the market makers. And why do they sell it to them? Because they want to trap them, right? If they reverse the price immediately, like that, then everyone who bought up here would be trapped. They would either have to stop out their positions in a loss or keep holding until they get liquidated. In either case, they would get stopped out as well. So this is just like a basic, very fundamental rule of liquidity and the underlying thing that moves the markets. So now that you understand that, let's go back to the bear flag that a lot of people are talking about. Is it possible for Bitcoin to go to 18K or 19K to play out the bear flag? And the short answer is we don't know until 28K 750 is broken. And if I'm gonna bet from my experience as like being in this market for as long as I have and seeing the things that I have seen, what I'm going to bet is bear flags don't generally tend to play out, fully, as much as, the traditional TA guys would like you to believe. What tends to happen is, you just target the liquidity. Once you take out the liquidity, you reverse. So in this case, you can see that the closest point of liquidity, or rather the major point of liquidity, is right down here at 32,900, which is give or take. Let's just count that as 33K. So this is also not just liquidity, but this is also a swing low. If you watch my macro analysis on Bitcoin, I said that we were potentially still bullish. And if you want to know my exact take on Bitcoin is, on a macro scale, and whether it is time for us to, just sell everything and get out of the markets before it goes even lower, you're going to want to check out that video. Even though prices are at these levels, I'm not really panicking just yet. So this is sort of like your range at the moment, and I'm very certain you're going to wick below this range before rebounding, because there is liquidity trapped beneath 32,900. And the question, right, the real question becomes, is this going to be the final level of liquidity that the market makers want to take out, or are they perhaps targeting something lower? And when I talk about something lower, I'm talking about 29K. So right now we are on the weekly chart. And if you look on the weekly chart, you can see that there is a lot of liquidity beneath this level. And the way you determine where there is a lot of liquidity is basically by multiple swing lows. The more swing lows that you form at that similar level, right, at a similar level, means the more people are going to treat this as quote unquote support. They're going to place a stop loss. The more people are going to place their stop loss right beneath, right, the more liquidity there is, the more money these market makers tend to make, and they're not going to pass up on easy money. So in that case, the question becomes, is the final level 29K 200, or maybe even 28K, right, to wick below this before rebounding? Either way, my take is that either it's going to be 33K or either it's going to be 28K. Either way, markets move on liquidity. Once you take out the liquidity, you are going to reverse. It happens a lot. For example, right here, you have liquidity. The moment you take it out, look how it reversed immediately, right? It's on a weekly chart, so it's not immediately apparent. But if, let's say, I go into the daily chart, this will become much more clearer to you when I say that the moment you take out the liquidity there, immediately reverse, right? Trap all the buys here, stop them out before, screw everyone up, basically. And same thing goes for, just support as well. Because if we just go on to, say, the 1 hourly chart, right, all these blue lines right here are previous swing lows. And I want you to notice how price just very consistently, right, on every level, it wicks just beneath it before reversing, right? It tricks people to shorting here before reversing it. It tricks people to shorting here before reversing it. It tricks people to shorting here. Well, at the moment, they would still be in profit, but you get my point. This happens like clockwork, and once you understand this, you sort of have a very good understanding of why the markets move the way they do. So basically, I know I just spent like 6 minutes beating around the bush, but my opinion is that this is not a bear flag. I mean, this is a bear flag, but very likely won't play out. You know what I mean? There is no reason for them to take it down that low, at least without some kind of a short-term reversal or even a mid-term reversal. So if you talk about a mid-term reversal, then the price to watch is going to be at 37K 400. The reason for that is because right now, this entire block here has become a weekly block of supply, right? Supply is basically a level where you go in there, there's a lot of supply, so there's a good chance that you get rejected. So if you do go back to 28K, the immediate level that you're going to want to take your profit, right, or just take some profit, is going to be at 37K 400 and 40K 700. In fact, you could even go as far up to 44K. But either way, these three levels, you're going to want to keep them in mind and you're going to want to take your profit. The reason is because this is a zone of supply. Until you break this zone of supply, you are bearish until proven otherwise. But my take is that the lowest it can go, probably just there. And I know nobody likes to see that. I do not like to see this as well, but we're traders. We're going to make money whether it goes up or down. And in the meantime, if you want to figure out if you can make money scalping the markets, then you're going to want to check out this video that I'm going to link right here. But for now, may the gains be with you, my friend. Bye-bye.